Kevin Warsh walked into his first meeting as Fed chair and didn't submit a
Wow.
dot.
Wait, the chair himself just skipped it?
Skipped it completely. Meanwhile, 9 of 18 officials leaned hawkish toward a hike this year.
9? That's half the room swinging one way with no dot from the guy running it.
That's interesting.
There it is.
Anyway, welcome back to the trade room.
Good to be here, and the timing on this one is rough. Banks start posting Q2 numbers in a couple weeks with zero rate guidance to model against.
So today, we're asking what Wall Street's clean story about wider margins and stronger loan growth is actually leaving out.
Yeah, like whether commercial real estate stress is really behind us or just quiet for now.
We're also tracking down what former Fed examiners are seeing buried in the reserve language of bank filings.
Curious, and how earnings calendars split banks into two very different bets under a stalled Fed.
Should be a fun couple of weeks to be a bank analyst.
Or a terrible one.
So, let's start with the meeting that broke everybody's model. The dot plot used to tell markets what banks would do next. Now, it's gone.
Gone, like completely gone?
Completely. Kevin Warsh walks into his first meeting as chair and doesn't submit his own dot.
He just skipped it.
First sitting chair to do that in over a decade. Chase's rundown of the June meeting confirms it. No projection, no median contribution, nothing.
So what's the rest of the
Wow.
committee doing while he's silent?
This is the part that got buried. Tech Times reported 9 of 18 FOMC members are now projecting at least one hike in 2026.
9? In March, that median was leaning towards cuts.
Full reversal. Cut leaning in March, hike leaning in June, and the man running the meeting won't say where he sits.
So banks report Q2 earnings in a couple weeks into a Fed that just deleted the map analysts use for net interest income.
JPMorgan reports first. Finance's preview has analysts projecting a high single-digit rise in EPS.
And US's rundown of the earnings calendar has banks leading the whole season, kicking off the second week of July.
Which means every one of those models assumes a rate path that Warsh just refused to confirm.
So every analyst on every call is guessing?
Or repeating a guess from 3 months ago that already looks wrong.
Which makes me wonder what story Wall Street told itself before this happened, guidance or no guidance.
Building on that blackout, here's the story Wall Street told itself anyway. Higher for longer rates, fatter margins, banks print money. Simple as that.
Net interest margin expands because loans reprice faster than deposits. That's the mechanism everyone's leaning on.
Finance's piece on JPMorgan's Q2 report, published June 25th, has analysts projecting a high single-digit EPS rise.
And it's not just JPMorgan. Zacks earnings trends coverage, looking at JPMorgan, Citigroup, and Wells Fargo together, has Wall Street calling for loan growth to accelerate this quarter, trading revenue up 10 to 15% year over year.
Which sounds great until you ask the question nobody's asking on the call.
Go on.
The whole story assumes commercial real estate stress from 2023 through 2025 is already done, reserved for, boxed up, behind them.
Is it, though? BRG's research flagged something like $2 trillion commercial real estate debt maturity wall banks still have to work through.
$2 trillion. That doesn't sound boxed up to me.
Here's what I've learned sourcing deals. The call script and the 10Q footnotes get written by two different departments with two different incentives.
The call and the filing don't always match.
The call says well-positioned. The reserve build language buried in the filing sometimes tells a different story entirely.
So the whole consensus is priced for a clean story. Margin expansion, no drama on credit, nobody's stress testing that.
And nobody's checked whether the balance sheet actually agrees with the transcript yet. That's the part that bugs me.
Why would management downplay it on the call if the filing says otherwise?
Because the call moves the stock price today. The footnote just sits there until someone reads it.
Fair. So, high single-digit EPS growth, double-digit trading revenue, and a real estate wall nobody's pricing. That's the setup.
Which is exactly why the next conversation matters. How you build a rate model once the dot plot's gone dark.
Building on that reserve versus script gap, let's look at how the income side even gets modeled without a dot plot to anchor it.
Right, because NII forecasts run off a rate path, and right now there isn't a clean one.
So walk me through it. No dots, what goes into the spreadsheet instead?
The Fed funds futures curve. Fed held at 350 to 375 for a fourth straight meeting, but the median 2026 dot jumped to 3.8, up from 3.4 back in March.
That's different. So 6 months ago, the desk models were all built for cuts.
Yeah.
And now?
Now, the tail risk is a hike, not a cut. Nobody's saying that on the call, but the models are shifting under the hood.
Shifting under the hood. Walk me through the math on that. What actually happens to margin?
Under a cut path, deposit costs fall faster than loan yields reprice down. Margin widens. That's the story we already laid out. Flatter but higher, deposit betas stay sticky, funding costs don't drop, and fewer borrowers refinance, so loan repricing slows too.
So the margin story flips.
It compresses instead of widens, 20-30 basis points depending on the bank's asset duration.
20 to 30 basis points on a $1 trillion balance sheet. That's real money.
It is.
So when a call says we're well positioned for any rate scenario,
Interpret it as asking which 20 basis points they're eating. Well-positioned for a cut and well-positioned for a hike are not the same book.
and nobody hands you that number.
Nobody's handing that number out anywhere yet.
Which means the income side's murkier than the consensus wants to admit. Now flip to the other side of the ledger, not what banks earn, what they might lose.
The reserve side.
Where the CRE math actually lives and where the next conversation starts.
So here's how former examiners actually read a 10Q. They skip the call transcript. They go straight to the reserve build line.
Walk me through what they're circling.
The ratio between loan loss reserves and CRE exposure. If reserves grow slower than the loans maturing into a bad market, that's the signal.
And what's maturing right now?
BRG's research puts the commercial real estate debt maturity wall at $2 trillion, still moving through bank balance sheets. Bank health data's tracking shows office vacancy sitting above 20% across a lot of major metros.
$2 trillion, still unresolved after everything we discussed on margins.
Still moving through, and CREdaily.com flagged something odd. CRE reserve coverage ratios actually fell in the fourth quarter of 2025.
Fell, right before conditions got worse.
Right before yields moved and geopolitical risk spiked in Q1, banks eased reserves at exactly the wrong moment.
Translate the jargon for me. What do examiners call it when a bank keeps extending the troubled loan instead of marking it down?
Extend and pretend. You push the maturity date, avoid recognizing the loss, and on paper, the loan still looks current.
But the risk itself hasn't moved.
It's moved from recognized to deferred. Examiners care about that gap. The loss is sitting there, just not booked yet.
So if coverage fell in Q4 and conditions worsened in Q1, is the Q2 bill catching up or still behind?
Honestly, nobody outside the bank knows yet. That's what the footnote shows in 2 weeks.
Which means the real story isn't the headline number. Yahoo Finance already has analysts projecting a high single-digit EPS rise for JPMorgan.
Exactly. Watch the reserve line sitting underneath that beat.
Zooming out from that reserve gap,
The whole sector reports inside 48 hours. JPMorgan, BlackRock, Wells Fargo, Citigroup, all on July 14th. Then BOA and Morgan Stanley the next day.
so that's basically the entire sector back-to-back?
Pretty much. The news laid out that exact calendar this morning.
So with Warsh sitting on his dot and rates hawkish but stalled, who actually benefits?
Trading desks. Morgan Stanley leans on trading and wealth management, not spread income. A stalled Fed with hawkish noise means volatility, and volatility pays traders.
Versus JPMorgan and Wells Fargo who live on net interest margin.
Right. Deposit-heavy banks need the Fed to actually move. Stalled is the one word they don't want to hear.
Walk me through the trading number, though. Growth's been strong mid-quarter.
The estimates I've seen put trading revenue growth in the 10 to 15% range across desks, but investment banking and M&A stayed flat. Geopolitical uncertainty froze a lot of pipelines.
So the banks getting paid to trade chaos look fine. The ones getting paid to close deals are stuck.
That split matters more than megabank versus regional this quarter. Rate-dependent earnings against deal flow-dependent earnings.
And that's a sharper line than anything Wall Street's drawing right now.
Yahoo Finance flagged JPMorgan specifically. Analysts model a high single-digit EPS rise for Q2, but average masks it. Chase's deposit base is the number underneath that matters.
And Morgan Stanley just doesn't carry that risk at all.
No, which makes July 14th and 15th a referendum on which model survives a Fed that won't commit.
And that referendum needs a scorecard.
Which is exactly what we're building next.
Short pause.
Short pause.
With that split in mind, rapid round, what went wrong in how banks talked about reserves this cycle?
They front-loaded the calm story on the call and buried the real number in the 10Q footnotes.
So it's not a disclosure problem, it's a sequencing problem.
Right. Call first, filing weeks later. By then, the stock's already priced the nice version.
Who should have caught the reserve gap first? Examiners, analysts, or the CFOs?
CFOs. They set the number. Examiners react to what's already on the books.
I'd put weight on analysts, too. If you're stress testing a balance sheet against a $2 trillion CRE wall and you don't flag falling coverage,
That's on them as well. Fair.
rerun Q1 and Q2 with the hawkish dot plot known in advance. What do I change?
I'd build reserves higher in Q1 before anyone's watching that closely. Nobody punishes a bank for moving early.
I'd change the call script, not the balance sheet. Say the coverage ratio out loud instead of hiding it in a table.
Same numbers, plainer sentence. Market probably reacts calmer either way.
Okay, one number listeners watch July 14th and 15th.
Net interest margin, quarter over quarter. Year over year hides the flattening.
I'm watching the CRE reserve build specifically, rising faster than exposure matures or slower.
If it's slower again, we're back
Wow.
here in October having this same fight.
Same script, different quarter.
July 14th and 15th. Mark it down.
So, the moment that's staying with me is Warsh walking into his first meeting and just not submitting a dot.
Yeah, dude, he handed the market a blank page right before earnings season hit.
And 9 of 18 members leaning toward a hike doesn't help.
Right, so the takeaway, watch the NIM guidance on the 14th and 15th like it's the new dot plot.
Exactly. JPMorgan, Wells, Citi, BlackRock on the 14th, B of A and Morgan Stanley the next day.
Exciting. Mark your calendars.
New episode every Tuesday. Subscribe wherever you're listening.
And if this one changed your mind about bank earnings, send it to whoever swore margins were a lock.
Thanks for spending this time with us.
See you next week.